The exact warning sign that appeared right before the 2008 housing collapse just showed up again. Not a different version of it, not something that looks similar, the exact same thing. And the people who are supposed to be watching for this are either not paying attention or hoping you are not. Adjustable rate mortgages are surging back into the American housing market. And if you know even a little bit about what went wrong in 2008, that sentence alone should make you stop. Because one of the core problems back then was simple. Too many people had loans on homes they genuinely could not afford to repay. When that broke, it triggered a foreclosure wave that wiped out trillions in household wealth. Adjustable rate mortgages were not the only cause, not even close. The deepest problem was a broken lending system handing out mortgages to people who should never have qualified. But adjustable rate mortgages accelerated everything. They poured fuel on a fire that was already burning. And right now, in 2026, we are seeing both of those conditions active again. Lending standards have loosened to levels not seen since 2008, and adjustable rate mortgages are climbing back. These are not two separate warning signs. They are the same warning sign appearing twice. The last time this setup played out, it did not end quietly. So why would anyone choose an adjustable rate mortgage? Well, the answer is straightforward. It makes your monthly payment smaller. And since most people in this country decide whether to buy a home based almost entirely on what that monthly number looks like, the appeal is enormous. Here is how it works. With a typical adjustable rate mortgage, you get a locked fixed rate for the first years of the loan. That window is usually 5, 7, or 10 years, with 5 and 7-year options being the most common by far. After that fixed window closes, the rate begins to float. It adjusts with market benchmarks and can move in either direction. Buyers are using this as a short-term affordability play right now. And it is actually the same basic logic behind what home builders are doing with their mortgage rate buy-down programs. Both approaches compress your payment into a number that feels manageable today and push the real cost into the future. The bet in both cases is that something will improve before the adjustment date arrives. Rates will come down. Income will go up. The market will cooperate. But that is a bet, and when the financial stakes are this high, the difference between a bet and a plan matters a great deal. Here is something interesting happening in the data right now that nobody in the housing industry has a clean explanation for. Mortgage rates have actually come down. They are sitting around 6.1% today. A year ago, they were closer to 6.5%. Real movement in the direction buyers have been waiting for. And for months, every housing analyst and industry spokesperson was telling us this would push buyers back into the market. Pent-up demand would unlock. Sales would recover. The market would start moving again. That is not what happened. Contract cancellations are going up. Home sales are sitting at 30-plus year lows. The pending home sales numbers for February were not a mild disappointment. They were a collapse. And pending sales are a leading indicator. They tell us where closed transactions are heading next. What they are signaling right now is not encouraging. So, rates are coming down, and the market is getting worse, not recovering, getting worse. That tells you the problem has gone deeper than interest rates alone can fix. The price of the home itself has become the wall, and incremental rate improvements are not moving that wall. Now, predictably, the experts have appeared to reassure you. They want you to believe that adjustable rate mortgages today are fundamentally different from the ones that created problems in 2008. They have 3 talking points, and to me, every single one deserves some serious pushback. First, the fixed periods are longer now, 5, 7, or even 10 years instead of the shorter windows common before the crash. That is technically accurate, but all that means is the risk got pushed further down the road. It did not disappear. It relocated to a later date. And the longer that window is, the further out you have to try to predict your income, your home value, and where interest rates will be when you eventually need to refinance. Second, lending regulations are tighter today. Okay, maybe on paper. But look at what is actually happening. We are watching borrowers qualify for loans at debt ratios that stretch the limits of what responsible lending used to look like. Tighter on paper and tighter in practice are 2 different things. Third, borrowers are more financially stable today. This one I find the most misleading. Yes, lenders check income, credit scores, and debt-to-income ratios. But nobody qualifies a buyer based on what it actually costs to own and maintain that home after the purchase. Property taxes, insurance, maintenance, HOA fees, major repairs. None of that enters the underwriting formula in any meaningful way. A borrower can clear every qualifying test and still be completely unprepared for what that house actually costs. Saying borrowers are more stable than in 2008 is a statement built on an incomplete picture. Here is where the numbers start carrying the real story. In 2026, adjustable rate mortgages made up 21% of all mortgage originations. That is the highest share recorded in 3 years. And the trend is still climbing. The industry explanation is that wealthy buyers in high-price markets are using ARMs as a deliberate financial tool. These are sophisticated buyers in markets where homes exceed $1 million. They can refinance before the rate adjusts. They are not desperate. They are strategic. That sounds reasonable on the surface. Then you actually look at it. These buyers are purchasing into markets where prices are already declining in multiple areas. Not everywhere, but enough to matter. If prices keep softening over the next 5 to 7 years, what happens to the refinancing plan? Refinancing requires equity. If the home loses value, equity shrinks. If it shrinks enough, the buyer may need to bring cash to the closing table just to complete a refinance. Factor in that cost, and monthly payments on the new loan could easily end up higher than a fixed rate would have been from day one. And for buyers who cannot bring that cash, they cannot refinance. The rate adjusts. Payments increase, and the asset that was supposed to build wealth becomes a liability they cannot exit without absorbing a real loss. We know what happens next. We have the receipts from last time. But here is the part that bothers me most about the wealthy buyer argument. These adjustable rate mortgages are not just being used to save a few $100s per month on homes buyers were already planning to purchase. They are being used to help buyers qualify for bigger loans than they could obtain with a fixed rate. That is a completely different situation. That is not financial optimization. That is borrowing capacity being artificially inflated by a temporarily lower starting payment. The real financial position of that buyer, relative to what they are purchasing, is weaker than it appears. This has risky behavior written all over it. And you have to consider the broader environment. The conflict in Iran is generating economic turbulence with no predictable timeline. The job market is deteriorating. White-collar layoffs are spreading beyond technology into finance, legal, and professional services, and now bleeding into blue-collar sectors as well. People's future ability to pay for expensive homes is genuinely uncertain right now. Buying more home on the same income in that environment sounds like a lot of risk. And based on this data, more people are doing exactly that. Both wealthy borrowers and the broader borrower population have been increasing their use of adjustable rate mortgages over the past few years. This is not a niche trend. Let me make this concrete with a scenario that is not hypothetical for a growing number of American households right now. Say you earn $250,000 a year. You buy a $1 million home with an adjustable rate mortgage. 5 years go by. In this version, I will give you the favorable outcome on the property side. The home goes up in value. It is now worth $1.1 million. You gained $100,000 in equity. Great. So far, so good. But here is what else happened in those 5 years. Your industry got restructured. Automation changed the landscape. Your employer is running leaner. Salaries at your level have come down. You are now making $170,000 a year. You go to the bank to refinance before the rate adjusts. The loan officer runs the numbers. Based on your current income and your remaining loan balance, you do not qualify for the refinance. Denied. Now you are not holding a financial tool anymore. You are holding a loan with a rate about to move against you, a house you cannot easily sell without absorbing transaction costs, and a refinancing door that just closed. Your options got very narrow very fast. So you say, okay, I will just sell the house. I have the equity. I will take the gain and move on. Well, at the upper end of the market, selling is not as simple as it sounds. I want to show you a real example. There is a property that first came to market in September 2024 at $6.5 million. Right now, it is listed at $5 million. At one point last year, it dropped all the way to $4.8 million before being revised back up. The seller has taken a price cut of between $1.5 and $1.7 million, and that home has been sitting on the market for over a year and a half. No sale. When you are trying to sell a property above $1 million, your buyer pool is dramatically thinner. Not as many people can qualify. Not as many people are willing to stretch that far when economic uncertainty is elevated. The higher the asking price, the narrower the market, and the more leverage buyers hold in any negotiation. Longer time on market means more carrying costs, more concessions, more pressure building from every direction. And then layer on top of that the possibility that mortgage rates do not fall on schedule. They could stay elevated for years. They could actually go higher. The conflict in Iran is already pushing rates upward. It happened just this past week. Wars are inflationary by nature. They drive government spending, disrupt energy markets, and pressure supply chains. Every time someone promises a conflict will be short and contained, history records a different outcome. Here is the most important thing economists are saying about this ARM surge, and I want you to hear this clearly. They are not saying buyers are choosing adjustable rate mortgages because they spotted a strategic opportunity. They are saying buyers are choosing them because they have no other viable path into the housing market. Homes have gotten so expensive that for a significant portion of buyers right now, an adjustable rate mortgage is the only structure that brings the monthly payment low enough to qualify. Without it, the purchase simply does not happen. Guys, how is that any different from someone buying with a 3.5% down FHA loan on a home they cannot realistically sustain? Different income level, different neighborhood, same underlying problem. A borrower using a financing structure to reach a price point their actual financial position does not support. Sure, a higher income might mean more reserves and more of a cushion, but that does not make you bulletproof, not when the economic ground is shifting the way it is right now. So, who should actually get an adjustable rate mortgage? Mostly no one. It is kind of like a reverse mortgage in that way. If you need one to make the numbers work, that is your clearest signal that you probably should not get one. The only buyer who can genuinely use an ARM without taking on serious risk is someone for whom a payment increase of $1,000 a month or more would not phase their monthly finances at all. Someone who could almost write a check for the property if they chose to. That group is roughly the top 10% of Americans, maybe fewer, and if far more than that, are using these loans just to access the market, which is exactly what the data shows. That gap between who should be using ARMs and who is actually using them is where the risk is building. The housing market has been on thin ice for years. Add a war, a deteriorating job market, and all of this economic uncertainty on top of that, and the uncertainty among home buyers is only going to increase. It does not matter if you are a wealthy buyer or not. People are going to be more cautious about making the biggest financial commitment of their life when the ground under the economy feels this unstable. And there is one thing that has not gotten hit hard yet, but absolutely could, and that is the stock market. A lot of people have been feeling wealthy because their portfolio balances are near all-time highs. If that starts moving in the wrong direction, you are going to see far more sellers and far fewer buyers in the housing market. And this market is not in a position to absorb that combination. Now, I want to walk through something that is happening to a real person right now, because it shows exactly what the end of this road looks like in real life. A woman reached out about a close friend and family member who recently lost their home to foreclosure. The property was auctioned. After satisfying the deed of trust and covering all the associated fees, there was roughly $100,000 in equity remaining, and now this family is trying to determine whether there is any legal deadline on recovering that money, or whether it can just disappear into the system. The home is in Virginia, and her question is simple. Will they ever actually see that $100,000? Well, first, to address what she noticed. Yes, foreclosures are going up nationwide, and significantly. Filings increased 14% last year, reaching approximately 370,000 properties. That followed a 3% increase from the year before, so the direction has been consistent. Just in January alone, filings were up 32% year over year. Over 40,000 properties entered foreclosure in that single month. States like Florida, Nevada, and Delaware have the highest rates in the country right now. And this upward trend has persisted for 11 consecutive months. 11 months in a row moving the wrong direction. Who is getting hit hardest? FHA borrowers. Delinquency rates are highest among this group by a wide margin. The reasons are not complicated. Lower credit scores, elevated debt-to-income ratios, and down payments of only 3.5% mean these borrowers entered homeownership with minimal equity, thin reserves, and high vulnerability to any disruption in income or increase in cost of living. It sounds familiar to everything we just talked about with adjustable rate mortgages, right? Different price point, same core vulnerability. And the job market is accelerating all of this. In February alone, 92,000 jobs were lost. The unemployment rate climbed to 4.4%. These are not small numbers, and behind every one of those data points is a household with a mortgage payment due. Back to Virginia and the $100,000. Before any surplus equity reaches the former homeowner, every lien on the property must be satisfied first. Second mortgages, home equity lines of credit, court judgments. All of that comes out of the auction proceeds before anyone calculates what is left for the homeowner. Then a formal legal claim must be filed for the remaining funds. In Virginia, that process can take up to 1 year. If the claim is not filed within the applicable time window, those funds transfer to the state as unclaimed property. And the $100,000 figure may already be an overestimate. Foreclosure auctions almost never hit full market value. The opening bid is typically set near the outstanding loan balance, and final prices often land somewhere between the debt and true market value. Here is how the surplus equity recovery process actually works, and why it is designed to be difficult. After the auction, whatever amount exceeds the outstanding loan balance and all recorded liens becomes the surplus. In theory, that belongs to the former homeowner. In practice, recovering it is a long, deliberate process with multiple steps, documentation requirements, potential legal fees, and a waiting period that can stretch to a year or more. The system functions like a customer service department that is betting you will quit before you finish. They put obstacles between you and your own money because they know a percentage of people will give up. Filing deadlines get missed. Documentation requirements feel overwhelming. Legal language creates confusion. At no point does anyone in that process proactively locate you and write you a check. The entire burden falls on the former homeowner to pursue every step. And there is a painful irony here. If you are foreclosed on with zero equity, the process is actually cleaner. There is nothing to chase, no surplus to wait for, no claim to file. You lose the house, and it is finished. But if you have equity, you lose the house, and then you have to spend months, possibly years, fighting for money that was already legally yours. More equity does not make foreclosure better. In some ways, it makes it more complicated. For homeowners in Florida specifically, which has some of the highest foreclosure rates in the country right now, the surplus recovery timeline can extend for years and often requires hiring an attorney who specializes in this specific area just to navigate it successfully. The practical lesson here is straightforward. The best outcome in any foreclosure situation is to never reach foreclosure at all. Every other outcome involves some combination of financial loss, time, legal complexity, and ongoing stress. But if you are already inside the process and you do have equity in the property, you fight for it. You find the right attorney, you hit every deadline, you document everything, because nobody else is going to do that for you. I make these videos specifically to help people see these situations clearly before they end up inside them. Because once you are in a foreclosure process, your options are limited. The time to understand how this works is before you are sitting at a closing table signing documents on a home you cannot sustainably afford, or before you are choosing an adjustable rate mortgage because it is the only way to make the monthly payment work without fully understanding what you are agreeing to 5 or 7 years down the road. This information needs to reach more people. If you found this useful, share it. There is a structural force pressing down on every homeowner and every aspiring buyer in this country, and almost nobody is connecting it directly to what they pay for housing. The national debt is approaching $40 trillion. We are sitting at roughly $39 trillion right now, and the trajectory is pointing straight up. This is not just a political argument. It has a direct, measurable impact on the interest rate attached to your mortgage. Here is the mechanism. When the federal government borrows at the scale it currently does, it enters the same capital market you enter when you apply for a home loan. The government is competing with households, businesses, and banks for the same pool of available lending capital. When one massive borrower soaks up that much of the supply, the price of what remains goes up. and the price of capital is an interest rate. More competition for money means money costs more. It is not complicated. Economists have estimated that government deficit spending has contributed roughly 1 percentage point to mortgage rates over the past 10 years. 1 point sounds small, but calculated across a 30-year mortgage on a median-priced home, and it adds tens of thousands of dollars to the total cost of that loan. Not because of Federal Reserve decisions, not because of market cycles, because the government does not balance its books. That is a hidden tax on every homeowner in America, and most of them have no idea they are paying it. The ripple spreads further. Auto loan costs are elevated by an estimated $670 per loan over the lifetime of financing. Small business owners taking a 10-year commercial loan are paying nearly $8,000 more in total interest than they would in a more fiscally disciplined environment. And when businesses pay more for their debt, they pass that cost on through higher prices for everything they sell. The national debt does not just affect borrowers. It squeezes everyone. Everything we buy, use, or rely on gets affected by it. Now, I hear this response a lot. The government will just print its way out of this eventually, inflate the debt down. They have done it before, and they will do it again. Honestly, that is probably the most accurate prediction of what eventually happens. But understand exactly what that means for you. When they print, the value of each dollar decreases. Your homeowner's insurance goes up. Your property taxes go up. Your cost of living climbs across every category. Any loan you want to refinance in the future will carry higher rates in an inflationary environment. Owning property does not protect you from monetary expansion. It just means the nominal number on your home's value looks bigger. Bigger number, smaller real purchasing power. That is the math. The conflict in Iran is currently running at approximately $1 billion per day in costs. That is being added to a debt load that was already at unsustainable levels before the first action was taken. And the economic pressure from that conflict is already showing up in mortgage rates, which ticked upward just this past week. Wars are inflationary. They drive massive government spending. They disrupt energy markets and pressure supply chains in ways that take years to fully resolve. And every time officials promise a conflict will be brief and contained, history keeps its own separate record of how those assurances aged. We have seen this enough times to know better than to plan a financial strategy around them. Let me leave you with the number that I think reframes everything we covered today. Asset prices may eventually look higher in nominal dollar terms. Sure, 5 or 10 years from now, the number on your home might be larger. More dollars chasing the same assets produces nominally higher prices. That is inflation working, not wealth being created. But if you convert those home prices into gold instead of dollars, the picture changes completely. Right now, in 2026, home prices measured in gold are sitting at roughly the same level they were in the 1980s. Think about that for a second. 40 plus years. 40 years of climbing dollar prices, 40 years of record home values in the headlines, 40 years of people believing they were building generational wealth through real estate. And when you strip out the inflation and measure in real money, housing prices have gone essentially nowhere over that entire period. That is the number, behind the number, not the dollar amounts on Zillow, the actual relationship between what a home costs and what your money is genuinely worth. And that relationship is what should be informing your decisions right now, not monthly payment math built around a temporarily lower rate on a loan that can move against you in 5 years. So, let me bring it all back together. Adjustable rate mortgages at a 3-year high at 21% of all originations. Lending standards the loosest since 2008. Contract cancellations rising. Home sales at 30-plus year lows. Foreclosure filings up 32% in January year over year. 92,000 jobs lost in February. Unemployment at 4.4%. A $39 trillion national debt. And housing prices that in real terms have not moved in 4 decades. The people who recognize the pattern early are the ones who get ahead of it. If this gave you a clearer picture of what is actually happening right now, help get it to more people. Leave a comment, hit the like button, and share this with someone you know who is thinking about buying. The algorithm decides who sees this based entirely on your engagement, and the people who need this the most are the ones who have not seen it yet. Check out the next video, right here, and I will see you over there.